Earlier today, Beverage Insights on Twitter reported that Celsius continues to take market share, with energy drink volumes up around 13%, a small price cut as well. This caused shares to jump higher over 10% so far today. In contrast, the incumbents like Monster and Red Bull are showing volume declines. Monster showing a pretty sizable 4% drop in volume, and some sort of price increases. And overall, the market itself, energy drink volumes were only up around 1%. So clearly Celsius is taking market share. Why? I think it comes down to the fact that Red Bull has the equivalent of one Snickers bar in terms of sugar for each consumption. And a lot of folks are saying, wait a second, I'm looking for a boost. I'm not looking for diabetes. And Celsius is a relatively healthier option than Red Bull, Monster, because what you're talking about is the sugar-free, low-calorie, heck of a kick with the amount of caffeine they put in those cans. Personally, I can't handle it. Like if I were drinking Celsius, I would be on this call, I would be on this video chat, or I'd be making a video, and then all of a sudden, like, my heart would pop out of my chest. So too much caffeine for me personally, but clearly a lot of people are looking for a kick, and they're looking for a relatively healthier kick versus the market options, and that's why they've been winning share, and that's why it's been a strong growth company for several years. Not recently the case. Now, when I look at my personal investment portfolio and my checklist, and I do own Celsius stock, my checklist is fairly simple. I'm looking for aligned management, compelling valuation, obvious growth potential. Now, I just talked about the growth potential and how they've historically won market share as a relatively healthier option. But the aligned management part and compelling valuation do leave people wondering, and also this right to win. So we'll talk about all these dynamics in this video, because the reality is, I would argue Celsius is more of a special situation versus the sort of core positions I normally have in my portfolio, where I'm saying, hey, I want something where, a core position might be something where I want a founder that has 30% of the company. They still own it. They're still running it. This is their baby. And they're like, here's why we're going to keep winning in the next 5 years. And I'm able to pay a below market valuation. That's the type of setup that I love, because below market valuation, maybe it's trading at 15 times free cash flow, 20 times free cash flow, and management's crystal clear, hey, this is what's going to drive this growth. It's very obvious to me. I can, write it out in a crayon practically. And also there's the alignment. When I see 30% ownership, or this huge amount of ownership, I know that if there's some sort of devastating macro event, they probably have thought about it themselves, because this is their baby as well. So I prefer to have that alignment with my own investment journey. Here, you don't really have that as much. I'd say this is more of a special situation. I called out previously why I thought it was somewhat of a special situation when I did a whole video on the prospects of Pepsi buying them out. There's just so many data points that point to it. One of which is the example where management, recently put in a contract that says, hey, if Pepsi acquires us and then we ultimately get fired, even if it's not for any sort of cause, we still get a nice sort of payout. And that's, that the sort of golden parachute is often happens. You put that in paper before the acquisition, because you want to get, some sort of nice treatment after the takeover. And keep in mind, that's potential. It's hypothetical. Other people might say, wait a second, Daniel, you're looking at the CEO, John Fieldly, and, he recently sold $20 million plus of stock. Like, what are you talking about? Management alignment or management incentives? As always, it's critical to dive into the details. Look at the footnotes. And so people going, oh, wait a second, $20 million sales. Let's look at the reality here. So what ended up happening was, and you can see this footnote here, the reporting person sold such shares solely to pay the tax liability and cost of exercise upon the options settlement. Wait a second. So he's exercising his options, and the cost associated with it, he's looking to settle the associated tax by selling the shares. But overall, he net bought shares through the exercise. Now, there's very low prices of around $1, $1 to $2. But the part that's really fascinating is the expiration date on these options ranged from 2027 to 2031. You're talking about years out. 2028. Why would he exercise his options years ahead before they expire? I suspect that perhaps he sees the recent noise created by Pepsi's inventory rebalancing, which has caused the stock to plummet. People saying, oh my gosh, growth isn't there. And he thinks the current price is fair. Maybe he even thinks the price is cheap. And perhaps in the future, as I've alluded to in that prior video on Celsius, especially if there's a potential takeover offer, the price could be higher. This way, he can lock in long-term capital gains by owning the shares outright versus exercising exactly at the time of the takeover. So if he holds the shares for, let's say, more than a year, then he's going to get favorable long-term capital gain treatment versus if you're to exercise at the time of a takeover offer where it'd be treated more as taxable income. That's a big difference, especially if you're talking about, millions of dollars and potentially a high tax bracket. What are my thoughts on valuation? Because this is one where I see a lot of confusion. First, as always, this is not financial advice. Also, recently, James, a premium member of the exclusive Unrivaled Investing community, shared, this is a direct quote, was very happy to have re-upped my annual subscription, enjoying the contributions and wisdom of the Unrivaled community. If you're looking for compelling investment ideas, come check out Unrivaled Investing. Prices are going up very soon. It will never be lower than this, so now's the time to lock it in. Looking at Celsius broadly, this is the reason why they've won over time, or this is the reason why the stock has gone up over time, which is that they've continued to take share. More recently, though, it's been sort of stumbling, causing investors to worry. Oh, are they, is this upward trend still happening? Well, clearly Monster and Red Bull are not taking share. They're still a winner. But the challenge is that there are other players like Alani Nu, which reported volumes shooting up 78%. This is the reason why Celsius is not a core position in my portfolio. I own it because I think it's a special situation, but I'm mindful of the fact that there are competitors that quickly take share, and it is possible that consumer brands and taste preferences change over time. So I'm aware of these risk dynamics, and I do not like seeing competitors that are taking share faster. So that is a yellow flag to be aware of. But I also look at Celsius, CELH stock, and I compare it against Pepsi or Monster, and I see that not only are they growing faster, but they trade in line on a forward earnings multiple and a price to free cash flow multiple. And you can see all this at AI Ticker Chat. This is the comps feature. And so to have a company that's not only taking share and is growing faster, trading in line with its comparable businesses, competitors as well. That is interesting to me. There should be a significant premium if you're taking share. Another factor that goes into valuation that I think a lot of folks miss is a lot of folks look at the PE multiple and go, wait a second, this is a crazy high multiple. And part of the reason why is because they're paying sizable amount of dividends to Pepsi via their preferred stock investment. I think if you're going to think about this investment and factor in that there's effectively two different possibilities, one in which Pepsi buys them, one in which Pepsi doesn't. If you factor in the cash that they have, and it's a mountain of cash, nearly $1 billion of cash, and where their profit margins could be clearly, and I think this is what Pepsi would reflect on if they were to consider acquiring them, at $34 to share, at $34 per share, to Pepsi. So if Pepsi were to consider going through with it, it's really only 21 times adjusted earnings to them, which relative to Pepsi isn't that expensive. So that's factoring in where their margins could be, factoring in, backing out the preferred share investment, thinking about if Pepsi treated this as a 100% owned vehicle at the current price, that is not expensive for a business that is still taking market share. That is a critical point for investors to consider. And this is once again why it's a special situation. The other scenario is, okay, so maybe Pepsi doesn't acquire them. They have other priorities. Even without any adjustments, they're still trading at, let's say, around 30 times free cash flow, give or take. That's not expensive for a winning brand. And let me walk through the logic real quick, because I think a lot of folks sometimes get confused. There's only three variables that drive your returns as an investor. There's the change in valuation, there's the free cash flow that can go to you, and there's the underlying fundamentals of the business. Let's assume the underlying fundamentals of this business only get you to about 5% growth going forward. I don't think that's the case. I think you could make the case for even higher over time, but let's be super conservative. Let's say it's only 5% over time. At a 30 times free cash flow multiple, not dirt cheap by any means, but around 30 times free cash flow multiple, you're getting roughly 3% free cash flow that accrues to you as a shareholder, that builds up for you, that ultimately can be distributed to as dividends or buybacks over time. So if you have 5% growth plus 3% cash, you're talking about an 8% type of return over time, very much in line with the market. So I view this as, hey, the downside is Pepsi doesn't do a deal and you're growing, long-term in line with the market. The upside is Pepsi does a deal and you get some sort of premium over time. So that's the reason why I consider this a special situation. Also refer to my prior video talking about the details on why I think it's more likely for Pepsi to consider an acquisition of Celsius. If this video has been helpful for you, please make a point of hitting that thumbs up, hit that subscribe button. Thanks so much for watching Unrivaled Investing.